Hello and welcome to NDTV Profit. As we step into 2024, the Indian real estate sector stands on the brink of a profound transformation propelled by a confluence of dynamic market shifts, strategic policy adjustments, and the ongoing recovery from the global pandemic. Well, everyone wants a piece of the pie, but everyone cannot afford a piece of the pie. But the good news is you actually can now by owning a REIT. We have with us a very special guest joining in. Ritwik Bhattacharjee joins in. He's CIO of Embassy REITs. Ritwik, I'm going to start with a very, very basic question. Everyone wants the piece of the pie. Real estate is an asset class that Indians have historically loved and owned and also gotten rich because of real estate. Of course, those times were different. Fast forward 20, 30 years, real estate is not as affordable anymore for most Indians. But everyone wants to make, I guess, some money off this asset class, and REITs, I believe, is one way of being able to own a piece of the pie. Talk to our viewers and tell us, what is a REIT? Break it down, simplify it.
Sure. Well, first of all, Samina, thank you very much for having me on the show, and Happy New Year to you and all your viewers. So let me break this down very simply. You really hit the nail on the head regarding sort of what a REIT should be. Very simply put, everyone should think of a REIT as being a high dividend paying stock run by a company that invests in commercial real estate. That effectively is the essence of what a REIT is. It stands for a real estate investment trust, but fundamentally, a REIT owns commercial properties that could be office, could be malls, could be warehouses, logistics, as is the case the world over. So let me and then you takes the rents, adjusts for financing, maintenance, interest costs, taxes, and then pays out the rest of distribution. So if I had to put that in very simple terms, the way Embassy REIT works, we run a 45 million square feet portfolio of office space, the best office space in India, anchored in large part by our base in Bengaluru. We now have to pay what we do. We've been listed for 5 years. We coming up on 5 years. In that time, we have leased 10 million square feet. We bought over 10 million square feet of growth, and we've paid out 10,000 or close to 9,000 crores of distributions to unit holders. Now, there are three main things that a REIT has to do from a regulatory perspective, and this is roughly true sort of globally across the structure, and I'll get to the global part in just 1 minute. Firstly, a REIT has to pay out at least 90% of our cash flows, not profits, but actual cash flows to unit holders or shareholders. That's a regulation. It's a SEBI-mandated regulation, and it's a regulation that exists the world over. The second is that 80% of a REIT's ownership of its portfolio has to be in rent-generating assets or completed in rent-generating assets, because that's what drives the distributions. You pay rents, you then adjust for the financing, the maintenance, and then it comes into distributions. We have 90% of our portfolio in completed assets. We're a 52,000 crore company by value, so you estimate roughly sort of 47,000 crores of that is completed. And we've paid out 100% of our cash flows to unit holders over 18 quarters. So effectively fully meeting every part and exceeding most of the REIT regulations. And the third piece, and this is also very important for every potential investor and every investor to know, is that REITs are very, very sort of safely and prudently managed and capitalized. We cannot have more than 49% of our asset value be levered or in debt. That's not the case with real estate, as we've historically sort of seen in India. So that what that does is really give us sort of a prudent set of sort of management controls. It's safe, it's governed, and it's really, with all of this, it really is a wonderful investment for any investor, whether you're a student, you're a professional, you're a retiree. You get the distributions, you get the growth and the capital depreciation that comes from owning commercial real estate in the country. And that's really the essence of why the structure was set up in India and why it was set up globally. They've been around for 60 years across the planet. It's roughly close to a $2 trillion asset class. There are 1,000 REITs worldwide, and it's a developed market structure. And it's come to India because this is sort of the real opportunity for any retail holder to safely and efficiently buy a REIT exactly the same way you'd buy a stock through your demat account. You can buy as little as one share. You can choose to buy it at any time. You will get paid your dividends every quarter, and you can choose to sell it at any time, just like a stock.
Ritwik, let's take this one at a time. And the good part about REITs is structurally they have a firm footing. India's real estate is often dodged by cash crunch and project delays, and you indicated that embassy REITs or the regulation of REITs ensures that the REIT invests in 80% of investors' money in completed and income-generating commercial projects. I want you to elaborate on this a little bit more, because this is a very important attribute of REITs that is also comforting for retail investors.
Absolutely, Samina. From our perspective, the biggest sort of security that you have is the ability to have stable cash flows. Now, before I go there, let me just add another quick preamble. REITs are not allowed to invest in any form of residential property, nor are they allowed to own raw unused land bank, which is effectively the essence of how developers sort of, operate and fund their businesses. And this is a very sort of, comforting piece of the entire sort of REIT structure and the equation. And it was designed effectively to allow retail holders to always know where the rents are coming from, where their dividends or distributions are coming from. Anything that puts the distributions at risk is effectively not allowed or excluded from the entire calculation of either the portfolio value or the actual sort of distributions that are paid out every quarter to unit holders. And we, it's in Embassy REIT's ethos, and I think in every REIT's ethos, to abide by that as much as possible, because this is a structure that is new in the country. We wanted to make sure when we listed in 2019, close to exactly 5 years ago, it was completely unproven. There was a lot of backlash and a lot of skepticism around how is this cash flow secure? How are you going to actually pay this out? Residential real estate has historically been sort of a damn squib in terms of sort of some of the governance issues and how opaque it's been. And I think what we've really sort of, made sure that the 80% rule is something that we've absolutely sort of sworn by. And in fact, we're sitting at 90%, and we always want to make sure that the development in the portfolio is always run on time, on budget, and delivered so that it adds to the 80% bucket and continues to give rents as quickly as possible.
I think, what is the minimum ticket size of making an investment in a REIT like yours?
Yeah, there's no minimum ticket size. I mean, you could buy it exactly the same way you buy a share on the NSE of any other stock on the Indian Stock Exchange. So it's effectively the price of any of the four REITs that you actually choose to, should you choose to buy one.
So I could essentially own one REIT and then earn dividend in proportion to the REIT that I own. You did mention that it's very similar to equity, a high-paying dividend stock in that way. The total size of the industry, I believe, of REITs is currently, 80,000 odd crores. On the face of it, this is definitely substantial. But on closer look, Ritwik, I do understand that it's not a very liquid market. So while in principle you can buy and sell it, one big sell could of course disturb and make the space very volatile. On the other hand, you may not even be able to get an exit because these are smaller than the smallest of stocks, right?
Well, I think you're absolutely right that liquidity has been a little bit of an issue for the stocks. And again, I think a lot of that comes to the fact that this is a new sector. But I think if you're thinking of sort of turnover, we trade roughly, 7 to 8 crores a day. There is ample sort of supply in the market. I think we've never sort of had an issue with anybody telling us that liquidity is sort of a problem. We've traveled, over the last year, we've actually traveled to a number of different cities across India, educating them about REITs. And I think while they've never had any problem buying or selling it. So from a ticket size perspective, I think, there really isn't an issue. And a lot of that has to do with the fact that initially it wasn't a one unit ticket size that SEBI had mandated during our IPO. So we made sure that the regulators understood that liquidity was going to be an issue. People didn't have sort of the ability necessarily to go out there and buy ticket sizes lot sizes of maybe 200, as was the case in the secondary market earlier. But we're not seeing sort of, ample sort of complaints about liquidity in the retail market. Now, obviously, I think institutionally as well, that as you've noticed, sort of over the last sort of few weeks, there has been an ample increase in our public float. And that has contributed quite immeasurably, quite significantly to the fact that our shareholder base is quite diverse, it's diffused, and no shareholder owns more than sort of 10% of our stock.
Right. You've been around for the last, 4-5 years since listing. Give me a sense of the kind of rental yields, an average, if I may, that investors can earn. So what is it that you give back in terms of income generated for investors? I know there is a 10% withholding tax, and of course the rest of it is taxed in the hands of the investor. But what's the average range of rental yields or dividends one can expect?
Yeah, that's a great question. We think about this product in two different forms. So, it's fundamentally, you should think of it as a sort of a total return product, where it's built up on effectively the fundamental anchor to that is the dividend yield that we give out, which is roughly, at this point in time, we're trading roughly in the 7% range, which is effectively the cash that we play out. On top of that, there's obviously sort of the growth that should come from the capital appreciation that, I'll be transparent enough and say that it has been sort of, that there has been sort of a lack of it, simply because we've been facing quite a bit of sort of volatility across sort of our business lines over the last couple of years. All of that's changing, but what you should think about is that this firing on all cylinders in a normal, stable market, which we sort of see coming up in front of us, should absolutely lead to sort of a mid-teens return over time, and which has historically been the case, mid to high teens return, which has predominantly been sort of the returns that REITs have given investors over the course of many, many, many years.
This is compounded, Ritwik, or this is annual returns we're talking about?
We're talking about what should be steady state sort of annual returns, right? I mean, when you think about equities and you look about, equities tend to be more volatile. But if I'm putting out effectively a 7 to 8% sort of yield, and then on top of that you can build points in for growth due to leasing, acquisitions, thinking about the development we bring online. So there's no reason this shouldn't actually be sort of a mid-teens kind of return.
But that of course is the expectation. But as it stands right now, historically, the returns on the dividend has been about 7 to 7.5. Is that a fair number?
That's fair. I think there's been a fair amount of, like I said, volatility. I mean, we lost sort of a year and a half to the pandemic, and then there's obviously been this interest rate pushback over the last sort of year and a half. Despite that, I think, to pay out close to 10,000 crores or 9,000 crores in distributions to our investor base, collect 100% of our rents, I think we feel like the clouds have really sort of, parted at this point in time for, there's a silver lining for us, and we see a lot of momentum ahead, from a leasing perspective and that growth. So, over time, I think you should see capital appreciation, you should see growth in distributions, and I think the office sector is definitely normalizing after what's been a tough period.
I want to talk about, continue to talk about dividends actually. I know the payout, the frequency of payout is not mandated or determined by the regulator. So for somebody who's seeking regular income, and for the sake of their understanding, how frequently or in what intervals do you pay out a dividend? I believe it rests in the hand of the REIT, and there could be some amount of infrequency or lack of predictability in that sense here.
No. Let me just clarify that, Savina, just on that. So the payout frequency is mandated to be semi-annually.
Okay.
We went one step further when we listed, and we decided to do that quarterly. And so 18 consecutive quarters, that's never changed. That's not going to change. I think the expectation that our investors, our unit holders have, they love the cash coming in, and it's an absolute sort of privilege for us every quarter to give them that cash, and they've come to depend on it. We have retail holders obviously since our IPO who depend on that cash. They've come up to us and told us that they the dividends that we pay out, and it goes back to the point that we are a high dividend paying stock. We really abide by this principle of paying out every quarter, and we have no plans to change that.
Ritwik, let's talk about the outlook now for commercial real estate. And I believe Embassy has, your primary market is the South, which is Bangalore. When an investor is looking to add REITs to their portfolio, my first question, this I guess might be more from a financial advisor perspective, but I think most people would add about 8 to 10% of their financial assets to REITs. Let me know if you agree with that. And secondly, when you're deciding what REIT or which REIT to pick up, should the decision be more focused on geography, or should it be focused on just simply diversification between 3 or 4 players in the REIT business? That, I guess, would be helpful just to understand the strategy one should be adopting.
Yeah, sure. I think let me just break that down in a couple of different parts. Firstly, let's talk about outlook. Outlook right now for office space is very promising, and I really couldn't be more optimistic about our prospects. And the reason for this is very simple. Over the last 2 or 3 years, we've seen such muted demand from global companies, from the Fortune 500 companies, all the way down to Indian IT services companies, and for a number of different reasons. Obviously, the pandemic took a big chunk out of people's businesses, and work from home became a really big sort of motive in workspaces. But all of that, I think, plus on top of that, then you've had this interest rate blowback that has really crimped margins for most companies, so they've had to reduce their spending. This is probably the first time in the last 4 years, excluding the year that we first listed, that we've actually feel this sense of renewed optimism. We just announced the highest leasing quarterly leasing that we'd done at the half-year earnings mark. We've upped our leasing guidance to 6.5 million square feet for the full fiscal year that ends in 3 months. And all of this is actually predicated on the fact that we are seeing a lot of demand from the global capability centers that continue to invest in India, continue to hire. And, the case in point, Bangalore, 75% of our portfolio by value is based here. And some people think it's concentration risk. For us, this is an absolute weapon. We've got, 3 gorgeous business parks that are effectively running at near about full capacity without sort of, thinking about all the development that we have in the portfolio. Of the 7.1 million square feet that we have in development, 90% is in Bangalore, India's biggest office market. It's around a 200 million square feet office market out of an 800 million square feet total India office supply that's out there. And I think fundamentally, when we think about sort of what leasing is going to mean over the next couple of years, it's definitely has come back in a long way. There's 20 million square feet of RFPs in the market. Absorption last year hit close to sort of gross absorption was around 60 million square feet. If we believe everything we're reading every day about India has become a go-to destination, and you're thinking about the fact that the market's done very well, and you just sort of fast forward that over the next couple of years or even more, like 3 to 5 to 7 year horizon, hiring in India is going to be an absolute must for every single sort of global company. And we're seeing that. We're seeing that across sectors. It's not just technology. It's banking and finance. We've got JP Morgan, who's our biggest tenant. We've got oil and gas, you've got manufacturing, you've got healthcare, you've got, pharma, all different industries are coming to India to hire people to work across, serve all their global business lines. You add the fact that, globally you're seeing the Fed's probably lining up for a rate cut sometime sort of, this year in a couple of sequential stages. And I think you could really sort of see leasing come back in a big bang. So net, we're very positive about that. The second piece is, I think, talking about sort of the allocation that you think about, what people should put to REITs. And you mentioned 8 to 10%. Look, I think it really depends. Sort of, what are you looking for? If real estate is historically, listed real estate tends to be sort of 10 to 15% of sort of people's portfolios globally. You have it in the form of a mutual fund. You can have it in the form of an index. In India, we're not allowed, they're not in the indices as yet. It's something we are working on. But something sort of within, call it the 8 to 15% range is something that's quite sensible. You can buy it through a mutual fund. You can buy it individually. But the point I'm trying to make is you must have it in a portfolio. It's critical. It's not mutually exclusive to have it along. You shouldn't compare it to an FD. You don't have to sort of worry about sort of, a growth stock. This sits alongside a fixed deposit. It sits alongside bonds, corporate bonds, government bonds, equities, private real estate, currencies. It should just be a part of your portfolio, and it should be sort of part of an entire sort of well-managed, balanced buy and hold sort of strategy that I think every investor should have. So that's the second piece. And the third question that you asked was, obviously, what do you buy between the REITs? What do you choose and how do you choose it, whether it's geography or anything else? Look, I think it really depends on, I'm not here to sort of, comment or talk about sort of, which one is relatively sort of better placed. I'll just put it this way. When we listed, we were the first REIT to list. We had India's best office market in our portfolio. We still do. Bangalore is, our bread and butter and sort of the engine that fires a lot of the cylinders for Indian office. We believe that propelled us to sort of the top of the table to actually list when we did. And I think, our performance and our ability to deliver the returns and execute a business the way that we did in the middle of all this unprecedented sort of market blowback and volatility allowed the other REITs to list. So I think with that, what's great is that these are incredible, our compatriots in the market are incredibly well-run companies with, pedigreed sponsorship. It's really a personal choice about, which market you choose, where you actually determine your sort of, I guess, your relative sort of value loyalties lie. But overall, in any which way, you won't be making a mistake.
I completely take your point. And we've seen that, Ritwik, we've seen that with SGBs, sovereign gold bonds, very similar in nature, right? They pay out a dividend, financialization of an asset that Indians historically have liked and enjoyed. But one quick question, while there's been an enormous amount of discipline in terms of the dividend that you pay out, and like you said, you do it quarterly now, going one step ahead, there's been not too much capital appreciation. You highlighted the reasons for why we haven't seen that over the last 5 years. If I had to ask you in terms of, and you also said that leasing trends are improving, your earnings last quarter were actually better than what the street was expecting, and there is a very clear uptick. If I had to ask you for a guidance of sorts, would you be able to share with me what sort of growth are we looking at in terms of capital appreciation? A 10-15% upside annually can be on the cards over the next couple of years?
Yeah, so just transparently, I won't be able to give you any guidance for this year. But just bear in mind, we do report earnings in a month, so we'll have obviously an update on how the business is doing. As we've said, we've given guidance for leasing for the year, plus we have given some distribution guidance for this financial year, that's March 2023, which rests in effectively a range of 20.5 to 22 rupees per unit. So I think, in terms of guidance, I'll probably refrain from saying anything more. But look, I think capital appreciation on that point is very well taken. Candidly, I think we're all rather frustrated that the stock performance doesn't mirror how exceptional the business is. But having said that, we are patient, operators. We still will do the right thing for our unit holders and all our stakeholders, and continue running this business, through the good and the bad. I think, hopefully over the last few years, we've seen, all the bad get washed out of the system. And I think, once the market sees leasing come up, sees sort of the growth potential behind this company, the stock should hopefully re-rate, and there's your capital appreciation. So I'll stay away from a number right now, but I think you understand the way that we think about the business. We don't run a stock, we run a business, and we ask people not to invest in the stock, to invest in the business.
I completely agree. It's only a matter of time. The prospects, the history, your land bank, leasing trends, all working in your favor for now. But Ritwik, it was great talking to you. We'll hopefully catch you soon when you report your earnings and get better perspective. But until then, good luck and thank you very much.
Thank you, Samina. Thanks for having me on the show.